rand reversing some of its fortunes. We're sitting at around 707 to the US dollar. Of course, we hit 698 in yesterday's session. To what extent did the narrowing of the current account deficit have an impact on the local currency? We know that it's now only 2.5% of GDP. Some economists out there saying that that is not as important as some of the policies that we've been seeing coming through on the developed world, and that having far more of an impact on the local currency.
Yeah, well, I mean, the currency for the month has done extremely well, from coming at the beginning of the month at levels around 740 down to, as you say, 698. And that current account information this week certainly added a lot of value. And I mean, all factors are helping at this point, leading to the stronger rand. And as you say, we're seeing a little bit of a rebound at the moment. But yeah, the rand is really, really strong at the moment. Good figures out this week.
Just looking at the fact that most emerging markets are starting to gain ground on the currency front, purely because the yields are far better than that of the developed world, and also because of all the talk of quantitative easing. To what extent are we going to be seeing more strength coming through for the local currency in coming weeks, given the fact that many investors are starting to liquidate their positions when it comes to the US dollar?
Yeah, I think certainly with the FOMC comments this week confirming that there is scope for further quantitative easing. We saw the US Treasury yields dropping and yields across the world reacting as well. And there's no reason why you can't expect further appetite into South African bonds, with the yield differential still remaining very attractive. And as a result, that will feed through to the currency, certainly. So the outlook on the currency is definitely positive, as it must be for the bonds in the short term.
Well, James, we've got economic data due out in the US later, housing, and of course those employment figures as well. What impact is that going to have on the local currency? Of course, we've got a public holiday tomorrow. Liquidity also being quite tight in Asia, because we're seeing public holidays across the board as well.
Yeah, I think most importantly we'll be looking at those US figures out later, just to get some sort of idea of whether there's been some recovery in those home sales. That's quite important. And obviously the jobless numbers, they've as far as for our currency, I think we'll probably not have too much effect, being a long weekend here, and as you say, holidays in many countries today. I think we'll probably remain in a very narrow range as we go into the long weekend. So I don't think there'll be too much, unless there's obviously a major surprise when it comes to those figures.
We had those quarterly bulletin numbers out yesterday, current account deficit, which I was alluding to a little earlier, and of course the gross domestic product numbers. And we have been seeing a nice recovery in certain parts of the economy, particularly when it comes to durable goods. In fact, a nice recovery, the biggest recovery that we've seen since 1987. Give us some insight into that number, given the fact that, of course, the World Cup had a big part to play as well.
Well, the expenditure figures, though they are improving, they're improving. Well, they're picking up at a slower pace. What's important to look at, as you say, on the durable goods side, is obviously the effect of lower interest rates and easier access to credit really affecting it there. So people buying those durable goods on HP and terms. But going forward, we can expect possibly a similar pickup going forward in expenditure as those lower interest rates once again come through. As far as the current account deficit is concerned, obviously we've seen high commodity prices improving our export receipts, so that was also positive on that side, as well as lower dividend payments and improved trade accounts. So that could explain the improvement on the current account deficit.
Of course, household debt to income is still quite high. It's still above 78, even though we're starting to see a little bit of a downward trend coming through. You're saying that things are probably going to be remaining tight, but also just looking at the fact that we've seen an interest rate cut, 50 basis points, and it was pretty much priced in. The next meeting set to come through in mid-November. What are the markets pricing in at this point in time, or do you think the next set of data is going to be quite telling?
Well, yeah, I'll first just comment on the consumer side. It looks like the consumer's position is set to improve going forward. So I think hopefully we'll see some decline in the debt to disposable income ratios. As far as interest rates are concerned at the moment, as said at the last MPC, it'll take quite a bit to lead to another cut. The market at the moment is pricing in a 30% chance of another 50 basis point cut in the cycle, which is probably fair given the global growth outlook is still deteriorating and not looking as that it's going to be picking up anytime soon, as well as with the strong currency at the moment. That's obviously going to feed through to inflation. So I think next week's figures, certainly CPI, which is expected to come in just slightly lower at 3.6 from 3.7. We've got it here at Nedbank coming in at 3.5. That will be quite crucial. If that comes in a lot lower, I think that will be a significant thing to look for as it approaches the lower end of the band. So we'll certainly be looking out for those figures next week to give us some sort of view going forward.
Of course, it's a heavy economic week next week. CPI, PPI, money supply coming through as well. Most economists that we've been chatting to say that there's quite a high probability to see another 50 basis point cuts, and you're alluding to all the issues coming through on a global level. That, of course, could perhaps give the Reserve Bank governor another reason to cut rates. On the other end, of course, the rand has been very strong. We've reached that key 7 psychological level to the US dollar, and this is at a time where we see the IMF talking about the rand being overvalued by between 5 and 15%. If we do see another interest rate cut, do you think that could be a rand negative in the long term?
I don't think so, no. I mean, what we're seeing at the moment, interest rate cuts actually improving the outlook for the rand. It improves our outlook economically, and as a result, it leads to appetite on the equity side. So I don't think even, longer term, the risks are there to the rand, and certainly a large event risk would lead to a significant depreciation in value. But as far as we can see going forward, at least in the short to medium term, the rand, all things pointing towards strength at the moment. So the Reserve Bank do find themselves in quite a difficult position, as Ms. Marcus commented this week, that it's a difficult one to control. They certainly will be boosting their foreign reserves, but at the moment that's pretty much all they can do.
Let's touch on gold at this point, because we're so close to $1,300 an ounce. And again, it's really got to do with the fact that the US dollar is losing ground, and there's a lot of talk about more printing of money. Where do you see the yellow metal going forward? Because at the end of the day, it is driven by fear and a lot of uncertainty as to what the Fed's next move will be.
That's it. Obviously, you spoke about psychological levels. Well, 1,300 is going to be a major psychological level. But as you say, we're seeing sort of fear buying. We've seen all-time highs in the Swiss franc, which is also seen as a safe haven purchase. And dollar weakness will encourage further gold buying. So we'd have to see what happens going forward, especially with today's figures out of the States. But longer term, you probably will find, as long as the dollar's weak, that safe haven buying will continue.